I'm a sustainability advisor in Sweden at DGE in Sweden. I've been working with DGE for 13 years, and I do support my clients internally with their processes in terms of implementing CSRD. So I will try to give you some insights from that implementation experience. All right, so if we start by where we come from, so the CSRD is part of the Green Deal, the EU Green Deal, which was launched in 2019. And this is how the EU should transition into the future, a modern, resource efficient and sustainable economy with net zero emissions of greenhouse gases. And as part of the Green Deal, there is an action plan on financing sustainable growth, because that is such an important part, of course, of this transition. We need finance to move in the right direction. The EU taxonomy is part of this action plan, and now the CSRD, the Corporate Sustainability Reporting Directive. That's also part of the action plan to move, in order to be more transparent, the companies, by making companies more transparent on sustainability performance, the finance will be able to move to more sustainable companies. That's the essence of it. So if we just dive right into the main changes in relation to the previous directive, the NFRD, as Lauri introduced it, the Non-Financial Reporting Directive, the main changes, high level, more companies included. So the threshold is lower in terms of employees. It's now 250 employees. It used to be 500. And also all listed companies, including SMEs, are included in this directive. An important point as well is the harmonization with financial reporting, because today we see a lot of separate ESG or sustainability reports from companies, but now the sustainability reporting will be part of the annual report. It will be presented next to the financial statements. So this is really very much a harmonization into the financial area. We need the same external assurance for the information that is disclosed for sustainability as for the financial information disclosed. Also, digital tagging taxonomy, an XBRL taxonomy has been launched. So this will also be data that will be tagged as well in the same way as financial data. The responsibility of the board is increased. So now the board needs to take responsibility for the content of the report, not only the fact that there is a sustainability report. So actually the content of the report, in the same way that the external assurance and the board responsibility kind of goes in line here. One very important point as well is that the content is specified by these standards, the European Sustainability Reporting Standards, which are super important, of course, for the actual implementation. So now it's not only that you have to report on environment and anti-corruption and social aspects, but it's much more specified how you're supposed to report and what to include in your reporting. So, and if we look a bit at the timeline, in 2022, that's when the CSRD was adopted. And also the first drafts of the sector agnostic standards, the ESRS sector agnostic standards, were also presented. And then in 2023, those were finalized and adopted. So now we have final ESRS standards, which we can work with. During 2023, there were also implementation guidance launched by EFRAG, the European Financial Advisory Reporting Group, who are now working with or who are the main actors within this. And those implementation guidances are draft, but they're quite good, I would say. The materiality assessment is a good go-to when it comes to the materiality. So it makes sense to start working with them, I would say. But it's still in draft as it's published for another couple of months. And there is a list of the data points, which is also something that was very valuable, of course, because there's a lot of data points in the standards, and there is now an Excel list of the data points which are part of the ESRS. It's also a draft for now, but I think still, I mean, it's something to start working with, definitely. So in 2024, now we will see the implementation in national law spreading throughout Europe, but also there will be standards for SME companies, both for those who are listed, but also they can be used as voluntary standards for those who are not part of the reporting requirements, but who want to be in line, because of course this will become the new standard for reporting. So also companies who are not covered by the CSRD will want to use this as a guidance for sustainability reporting or ESG reporting. In 2025, we will see the first reports in accordance with the CSRD. And in 2026, which this is something that was postponed from the initial plan, there will be sector-specific standards. This is something EFRAG was initially planning to do that in 2024, but realized that the implementation of the standards already at place will take a lot of time. So they decided to leave that for later. Okay, and as I said, the reporting timeline. Sorry. From 1st of January this year, companies covered by the previous directive, the NFRD, will start their reporting. Sorry. So we will, in 2025, the first reports will be published, and they will then cover data on 2024, first fiscal year after January 1st, 2024. And then next year, in 2025, the rest of the companies, most companies covered by CSRD, will start their data collection and then a report in 2026. And then we will see others following. So what we have today are the sector agnostic standards. And those include the general requirements in ESRS 1. This standard includes how the reporting is supposed to be done, what the materiality assessment should be like, and so on. And then we have the ESRS 2, which includes general disclosures. So this is the only mandatory part in terms of disclosures. So all companies should report on the disclosures listed in ESRS 2. The topical standards are 5 when it comes to environment. There are 4 social standards and 1 governance standard. So those are the ones that we have today. And then there will be later on sector-specific standards and SME standards, as I mentioned. So if we look a little bit at the content of the topical standards, there are then topics within climate change, within pollution, within water, biodiversity, and circular economy, for example, for the environmental part. And these are called matters, all of these different aspects, you might call them. And as well, we have the same then for the social standards. So a lot of different matters that need to be addressed by the companies, and how to do this. I mean, the first way to prepare for the CSRD is, of course, to determine when, if your company is covered by the reporting requirements. So this is usually something the information that you get from your financial auditors. So that's where you should search for that information. The double materiality assessment and the building of knowledge on these different topics is also an important place to start your work on the CSRD implementation. And then after that, you need to make a gap analysis regarding the disclosures, because those disclosures that you're supposed to include have both governance perspective, and also you need to report metrics. So this is kind of two separate processes in your gap analysis. Do we have the governance in place that we need? Do we have the metrics in place that we need? So now a lot of companies need to work on both of these topics. When it comes to data collection, this is a large part of the preparations as well. How do we actually manage all this data? What is the technical application for that purpose? Do we need a new data collection system? Can we build on something that we already have? So this is something that is also important to think about. How do we manage all this data and the digital tags that we need to bring with them as well? And there are many different solutions for that. Lots of providers now as well selling their software. So it's a jungle out there right now. Everyone is developing as well their tools in order to be able to cover the needs of companies on this topic, of course. So it's good to start navigating, but maybe a bit later if possible, because a lot of development is ongoing. Then the auditor, of course, you need to have a dialogue with your auditor on how this will affect your audits going forward on the annual report. So this is also something that's important to start already. And the internal dialogue on processes and ways of working, because this is a whole new reporting where sustainability and finance really need to work together for much more than before. That's what my experience from my clients, that now today they have to sit down and discuss, because the finance functions, they know the financial reporting and how that's been structured. And now we need to fit the sustainability content, which the sustainability manager knows better. This content needs to fit with the financial ways of reporting. So it's really a process of learning together on doing this in a way that works for everyone, both in terms of the content that needs to be provided and also the processes. And when it comes to the content, the scope of the content, the materiality assessment is key. The disclosures in ESRS 2, as I mentioned, are mandatory. But when it comes to all the other data, then the materiality assessment is how you determine what to include. And the materiality assessment, as now the new concept of double materiality assessment is launched in the ESRS. I would say it's not super different to how I've always looked at materiality assessment, but there have been different methods, I know. So this is, to some, this is a new way of looking at it. But essentially, you look at the social and environmental impact of the company. So this is the perspective of your company having an impact on the world. And you have the perspective of how your company is impacted or affected in terms of risks and opportunities by the different sustainability matters. So by having these two perspectives in your assessment, you can then determine which are the material matters from either one of those perspectives or both. And that determines then what metrics and other information to be included in your sustainability statement. And when you look at the materiality assessment method, this is, you can either start by listing the matters. Now, this is the example that we have here. If listing the matters in the ESRS 1, this is a list. There's a table in the ESRS 1 in the annex. So you can just list all the matters in there and then identify risks, opportunities, and impacts related to these different matters. So that would be the first. Either you can work from the matters and you identify impacts, risks, opportunities, IRO, or you work by just using what you already had before, a materiality assessment that you already made. So you can work from that as well. The guidance does allow both those perspectives, but if you start from a list that you yourself have already generated, then you need to also make sure that you don't miss any of these matter perspectives. So then you would start with your own list and you would look through the matters and see which ones you do not cover, and then if you need to add any impacts, risks, or opportunities to the list. But I really appreciate the way that they are very, they have done a very logical definition, I would say, in terms of the impacts being then actual or potential. So you can have, your company has an actual impact, perhaps it's CO2 emissions then, that's an actual impact of the company. But you can also have potential impacts. So potentially you could have a chemical accident, for example. That would be a potential impact. And then you have to determine if it's a positive or negative impact. And you determine the severity. And the severity then is based on scale, how grave is the impact, scope, how widespread is it, and is it irremediable by character. So that is how you determine severity. And then for the potential impacts, if it's accident related or if it's a potential impact, then you would also determine the likelihood of that impact. And by making that assessment, you then determine whether it's a material risk, impact, risk, or opportunity, or impact in this case, if this impact is material for the company. And then if it is, then you will need to report impact related information in relation to that matter, in relation to climate change adaptation, for example. So, and then the second assessment starts, and that is the financial assessment. So you would then go through, do we have a financial risk or opportunity in relation to climate change adaptation, for example? So that could be if we have a risk in relation to the climate change that is coming, for perhaps it's in relation to resources that we are reliant on. So it's a risk on our business. And then we need to assess the potential effect, the financial effect in short, medium, and long term for the company. How much in now also, this is a new thing, I would say, in terms of how the financial part of the company needs to be included in this in the reporting process, because we will need the financial information on what potential financial effect these different risks could have on the company, but also opportunities. Maybe by offering new services, we can have a positive economic effect. And then in this case, likelihood is also part of the assessment, of course. So determining then that this is a financial materiality. This risk or this opportunity is material from a financial perspective, hence making the matter material from a financial perspective. And that means we need to report on financial effects and financial aspects or disclosures in relation to this matter. So yeah, and this I mentioned the different criteria. This is also listed in the materiality assessment guidance, so it's a good place to go. Then some points to consider on the double materiality assessment. You can relate to your previous materiality assessments, as I mentioned, but this is also a place to start. How well do we actually know the social and environmental impacts of our company? And the same then about the risks and opportunities, that this is an opportunity to get to know your company's risks and opportunities and impacts as well, because you will need to disclose on those different how you made your materiality assessment as well. So the auditor will need you to disclose how do you know that this topic is not material, for example. That means you will need to have evidence to show that you actually make this assessment in an informed way. And this is also something that takes some time now, actually creating the information, making the analyses. If you don't have a carbon footprint, or if you have no idea about the biodiversity impacts of your company, for example, because now we have a whole standard which is related to biodiversity. So you will need to start learning about the impacts of your company. Then stakeholders, of course, there are both affected stakeholders, those who are affected by the impacts of your company, but it's the stakeholders of the information, that those who will use the information that you disclose in your financial or in your annual report. So you will need to work on involving your stakeholders, and also this your involvement of stakeholders is part of the mandatory disclosures that you need to disclose under ESRS 2. So this process is something that you will need to disclose. We have different activities within companies. If you're a group, if you're reporting for a group, then you need to include all the different activities. And of course, then the materiality assessment will be different for the different activities as well within the company. If you have both property management, for example, and industrial activities, then the materiality assessment will be different, and you will need to then find a way to aggregate the different aspects in your group materiality assessment. Because generally the reporting is done at the highest consolidated level, so then that's also a bit of a difference. I think that this, because the reporting is so large, it's such a lot of work to do this reporting. So a lot of companies now maybe will not report at the lower level, but at the aggregated level more. That doesn't mean you can't communicate on sustainability at the lower level, and I think maybe we will see more of that the subsidiaries will communicate on sustainability and on their initiatives and actions, but the consolidated data and the full CSRD reports will be produced at group level. So also, of course, you need to decide then who to include in the materiality assessment. If you want to work internally or you want to include external experts in the work, and that's also part of your. And if you want to make this part of another process that you have, can you fit this into something else that you do? A risk management process, for example. And the format and documentation, that's, of course, part of the things that you need to think about. So once you've done your materiality assessment, then it's time to dive into the actual disclosures. And as I mentioned, there are the disclosure requirements within each standard. You can say that there are 3 different parts. So it's policies, targets, and actions. That's the more governance side of all these topics. But then there are metrics, so both impact-related metrics and financial metrics. So depending on your materiality assessment, you will then choose which metrics and disclosures to include in your reporting. And the next step then, under the disclosures, you will have different data points. So you will then work on the specific data points. So this is the data that's included in the list, the Excel list that's been produced by EFRIG. And then this generates an action plan for updating both your governance, so your policies, do you have the right targets and actions in place, or do you need to work on the strategy and governance? But also, do we have the right metrics and data collection in order to be able to show the size of this matter? So this is essentially the way that we need to do this. And just the final word, what will the CSRD lead to? Of course, it's going to be more comparable disclosures because we have standards. So this is one point that will be interesting. Now it's going to be more comparable. Different companies will not be able to hide the information as much. It's not possible to do that in the same way, but you will get to compare different companies. There will definitely be more focus on sustainability and ESG in the annual reports. This is going to explode. So it's really, the annual reports will be more sustainability than finance. And that's a large change. I mean, it's a really, it's definitely a change. And that means that essentially the focus on sustainability and ESG will be higher in that sector. We will also need to work more integrated, as I mentioned, on the sustainability and ESG work. And during the implementation, this is definitely going to be a burden in terms of work and resources, both internal and external, for companies who are required to report. And will it lead to more sustainable companies? Well, hopefully. We'll see what happens, but this is that's the intention, of course, from the EU to do this. Okay, so DGE, we can help you in terms of being the way that I work with my clients. I'm usually, holding their hand in trying to also manage this process, because it's things are changing. Okay, so now it's a draft and now it's finalized, and just that knowledge of actually being up to date with what is the current information and the current standards that are adopted. But also, of course, the materiality assessment, supporting when it comes to impact, because sometimes it can be hard, as I mentioned, to know the impact of your company. And we've been working a lot with companies of all sectors, so it's easier for us to know what's big and small in that sense. The gap analysis, we do have tools for doing that, and also, of course, when you need support on setting up your management systems and policies and actions and targets, we can help you out with that as well. Now, the auditing of the actual information is something that has to be done by accredited financial auditors, but we can help out as a more internal audits to make it a second party internal audit of your information. So preparing for the big audits. Okay, that was all from me. So I will let Anna talk a bit about how this is implemented in the legislation in Finland. Thank you.
Thank you, Nan, and hi everyone. My name is Anna Tuomisto, and I am a lawyer and consultant in DGE Finland. I would like to give you some practical examples of how CSRD looks like in a member state. And I use my own home country, Finland, as an example, and I explain you how CSRD was brought into force here. First, I'll give you some general information about CSRD implementation process, and after that I will point out few country-specific issues from Finland regarding assurance, publication of data, supervision, and sanctions. So, EU directives are not directly applicable law in the member states, but they must be incorporated into the national legislation separately. EU member states must bring the CSRD provisions into force by the 6th of July this year at the latest. In Finland, the CSRD provisions entered into force at the end of last year. This national implementation was done by changing already existing acts, mainly the Accounting Act and the Auditing Act. So we don't have a separate Sustainability Reporting Act, but the requirements can be found in several acts and decrees. CSRD itself is also an amending directive, which means that it mostly makes changes to already existing directives and regulations. The new reporting standards that Nan mentioned, they have been enacted in EU by a delegated regulation, which means that they are directly applicable law in the member state and they don't need to be implemented separately. Finland has implemented CSRD mostly under the minimum conditions. Our national legislation contains, for example, the same reporting content obligations as the directive does. CSRD allows, however, member states to have extensions at national level, which means that they are quite free to set higher standards than the ones in the directive. As an example from national extension, Finland has decided to widen the application scope a bit. So the CSRD applies to large companies, most listed companies, credit institutions, and insurance companies. However, in Finland, the reporting obligation applies also to the large cooperatives and most large pension providers as well. This has been justified by the fact that different types of companies shouldn't be treated in a different way. With CSRD, more and more companies will be subject to the sustainability reporting obligation. Before here, around 100 companies in Finland were subject to NFRD. But it is estimated that with CSRD, around 1,300 companies must report their sustainability data in Finland. Next, I will introduce you some legal aspects in Finland, and first few words about assurance, auditing in other words. So according to CSRD, a reporting company must select a third-party auditor or auditing firm to verify their sustainability report. CSRD amended quite a large number of articles in the auditing directive. The changes concern, for example, new qualifications for auditors and new regulation about assurance process. CSRD gives the member states an option to give the assurance right to an independent assurance service that is registered in an EEA state. This means that member states can choose to allow firms other than the usual auditors to assure sustainability information. Finland decided not to use this option. The verifier of a Finnish company must therefore be either an audit firm or an auditor with specific qualifications and approval under Finnish law. By October 2026, the EU Commission will provide auditing standards for limited assurance, which is the level of assurance required by the CSRD at the moment. Before this standard, the assurance may be based on other national or international standards. Yeah, and at this point, CSRD does not yet require a reasonable assurance of reporting. Reasonable assurance is required, for example, when auditing financial statements, and limited assurance is a lighter process and less costly for companies as well. Then about publication of data and supervision of reporting. Sustainability report must be presented in a digital format in a separate section of the annual report. As Nano also told you already. In Finland, the annual report must be submitted to the Finnish Patent and Registration Office together with the financial statement. Member states can require the companies to make the report available to the company's own website, and Finland has used this option. According to the new law in Finland, annual report, including sustainability report as well as financial statement, must be available to the public free of charge on the company's own website. And in terms of supervision, the rules are a bit open still. According to the directive, the European Securities and Markets Authority, ESMA, will issue guidelines for supervision of sustainability reporting. And ESMA has informed that they expect to publish the final guidelines in Q3 this year. In Finland, the sustainability reporting of listed companies, credit institutions, insurance companies, and pension providers is monitored by the Financial Supervisory Authority. Large companies that are not listed seem to be excluded from this supervision. And supervision of auditing is carried out by the Finnish Patent and Registration Office. Sanctions. In every member state, firstly, companies' administrative, management, and supervisory bodies must have collective responsibility for sustainability reporting. So in Finland, this responsibility lies both with the board of the company and the managing director. So they have collective responsibility. The member states must ensure that there are effective, proportionate, and dissuasive penalties applicable to possible infringements. Here in Finland, these sanctions are administrative. If the company doesn't register their sustainability report within time frame, a late filing fee will be charged. Also, the managing director or the board can be sentenced to a fine for accounting offense if they neglect the filing requirement. For listed companies, the Financial Supervisory Authority can impose other administrative sanctions. In our legislative process, the regulation of criminal liability and a sustainability reporting crime was also considered. However, this idea was abandoned during the process. It was considered that the criminal liability requires more precision and the content requirements for sustainability reporting are not precise enough if you compare them to financial statements, for example. And for sustainability reporting auditors, new sanctions were also laid down in Finland. Examples of these sanctions are warning, fine, and temporary ban, for example. Finally, I would like to highlight a few open questions that I find interesting. Firstly, it can be questioned if the administrative sanctions in Finland are effective enough. For example, a sum for late filing fee isn't that big. But on the other hand, the publicity can also be seen as one unwritten consequence. So if a company neglects its obligations, there will certainly be negative publicity and pressure from the outside. Also, many practical questions are open still, since we are waiting for sector-specific standards. And standards for SMEs, subsidiaries and branches, assurance and supervision. For example, the reporting requirements for specific sectors are expected to be adopted by the Commission by June 2026. So we can still expect more regulation and guidance. I would like to mention also one change in EU legislation that will affect the scope of CSRD. The size of the company affects whether it has to report sustainability data. The size of the company is determined by company's balance sheet, net turnover, and the number of employees. And these criteria are based on the accounting directive. However, in October 2023, the EU Commission decided to increase the balance sheet and net turnover thresholds by 25%. This increase will reduce the number of companies covered by CSRD. So some companies that are prepared for reporting may be excluded from the scope. These companies might be affected by CSRD because they can be a part of the value chain of another company, though. So the criteria might also change in the future again. So we'll see about the scope later. The European Commission must review the company size criteria every 5 years, and this time it was found necessary to change the criteria because of inflation. But yeah, so many things aren't yet set in stone. Thank you.